Hey guys, my name is Ryan. This is Independent Investor Channel. We're filming from New York City, New York. It's awesome to be with you guys. I've made over 60 videos now in the last 6 months or so on this channel. And I'm really going to be putting out some installments on just some basic stock market terminology. With my twist, I really try to offer content that isn't just as easily obtainable if you go and just Google what the definition of certain terms are, right? It doesn't do anybody any good. As a matter of fact, there's a ton of YouTube creators out there that are offering different content, and the value is, each one of us kind of deliver it in a different way, So if one YouTuber says something that kind of gets you into investing and another one kind of turns you off, well, then you want to kind of gravitate toward that information that's not only credible, but it's also entertaining and a little bit interesting to you guys. So, I think a lot of this information is just delivered in a ton of different ways, and it's really up to the viewer and the subscribers of the particular channels to kind of understand what helps them accelerate their knowledge more. So this is going to be my installation of one of my basic education principles. And a lot of the videos that I actually made when I first came out with the Independent Investor Channel, I'm going to actually go back and I'm going to be renewing a lot of those guys because some of the least favorite of my videos are quite frankly some of the most important. And I'm going to try to deliver those maybe with a different twist, maybe a different message. To really try to help you guys understand. This particular channel is really geared toward the newer investor, trying to get them on the path to self-directed investing as early as possible. Guys, I started mine 6 years ago. I've been investing my whole life, made a handful of mistakes, and have had a lot of success in the stock market. I'm an avid investor now, guys, so please enjoy. This is going to be what is a stock, and I've alluded to this before in some of my videos, talking about there not being a whole lot of appreciating assets in this life, all right? And stocks is one of them. Real estate is the other one. And those two are really interchangeable at number 1 and 2. There's a lot of arguments as to what's better. I love them both. I really do. Fine art and vintage autos, that's another two, but we don't dabble in those two. We talk about stocks and real estate, and mainly stocks as being two of those appreciating assets, guys. And listen, you might go through your entire life working and saving and trying to raise children and trying to put kids through college and whatnot. And the stock market can really be your channel for putting some hard-earned savings dollars to work for yourself. It might be small in nature at the start, but those dollars, no matter how small they are going to start to accumulate and appreciate in value as time goes on. Now, I say it all the time, if you choose to be a non-participant, then your dollars are going to remain static, let's say in a savings account, or even lose money when you start to attach inflation to those dollars. So a lot of people justify investing in a way to outpace inflation, and I think that's really, really fair. In that you're investing in basically a piece of a company, right? If you buy one share of Apple, as small as that piece may be, you actually own a piece of the success of that particular company. Goldman Sachs, Home Depot, McDonald's, right? And so on down the line, 3M. As these companies appreciate in value, then their stock will appreciate in value, okay? Now, if you're starting and you're saying, okay, I don't want to ever lose money in the market, we need to premise the fact that we need to be defensive in the stocks that we choose, okay? Because, if a stock goes up for a while, it could potentially go down. It could, hit a lull in earnings, or it could forecast that their particular sector is going to go through some sort of slowdown, right? So we don't invest and think that we're just going to make money year in and year out, okay? Some years you could be down, and other years you could be up, all right? But we talk about it all the time in the financial or the investing world as trying to achieve that 8 to 10% rate of return. We talk about that term all the time. And you're not going to get an 8 to 10% rate of return in a bank account. You're not going to get it in a money market account, and you're not going to get it in a checking account, okay? Furthermore, you're not going to get it by investing in bond funds or bonds either, okay? The only way to get that accelerated rate of return and outpace the effects of inflation is actually to participate in the stock market, okay, guys? So how much is it that we buy? It's relative, okay? The people that I'm helping right now for free, I'm talking to them. I really get a feeling for where they're coming from, and a lot of people are coming from a few $1,000s to upwards of $50,000 to $100,000. So it's really, really relative as to how much stock we buy, okay? Now, I always talk about entering the market, and I'm using the term passively or cautiously optimistic right now. With this particular stock market at an all-time high, I don't want you guys to sit on the sideline and not invest, but it's certainly worth acknowledging the fact that the stock market is at a record high right now, okay? And it helps to enter into the market in a scalable manner, okay? And if you've got $5,000, $10,000, $25,000, $50,000, the last thing I would recommend is just taking that entire chunk and throwing it at this market. I think the strategic way of scaling into this market is to take that chunk, you know, maybe 5,000, start that into the market, put a cash account aside, and then start dollar cost averaging those assets up, okay? So when I look at a stock like Apple at $150, one share of stock is going to cost you $150. And usually what I do is I get used to looking at a share of Apple and looking at it from a 10 share perspective, okay? So if I look at it, 10 shares is going to be $1,500. If I was going to look at a 5 share position in that, then you just cut that amount in half and you're at $750. And if you can kind of practice this mentality, you can get really, really good at looking at, let's say, 100 shares of AT&T, right, at $35 a share. That's $3,500. Cut it in half, right? You're at $1,700, okay, at 50 shares. And that kind of exercise kind of gives you an idea of how much of a particular stock you can afford that you're looking to buy, okay? When to sell. All right, this is a topic that I need to address because a lot of people are hitting me up talking about the $7 entry and exit fee. The $7 entry and exit fee, okay? And that's just the end-all, be-all of getting involved into a self-directed account. They're like, okay, hold on, Ryan, time out. You didn't tell me that we were going to be charged $7 to enter into a passive investment vehicle, guys, okay? There is a longer term perspective in this deal, and you have to trust me on this, all right? Actually, you don't have to trust me. Let me explain it to you really, really simple. If you are a starting investor and you have $0 to $5,500 per year to invest in the stock market, you absolutely should be looking nowhere else than in a retirement account, all right? A self-directed account is going to allow you to put assets into that account, set them up for dividend reinvestment, and set them up for dollar cost averaging going forward, guys, all right? Now, we are assuming over time that that account is going to go up, all right? And it's going to go up faster than you think, okay? When we start to get up to 10, 25,000, 50,000 especially, that's where some of those entry and exit fees are going to go away. They're going to go away, okay? And that's about the time when we are going to transition from an investor to a trader, okay? We're going to go from an investor to having the capability to do trading, okay? I talk all the time. New people who are getting involved in the stock market have to get their mind mentally conditioned and mentally practiced on watching their money go up. It's really, really exciting. And going down. It's really, really terrible, okay? Emotion has nothing to do with investing, and the longer that it's going to take for you to drive out the excitement when it goes up and ignore feeling bad when it goes down, okay? This is the time from $0 to $50,000 where that mentally conditioning should take place, okay? What does that have to do with when to sell? From 0 to 50,000, I want you guys to be buying assets that you do not have to sell, okay? Again, from 0 to 50,000, I want you guys to be buying assets that you do not have to sell, okay? So all you have to do is enter these positions with the idea that you are going to accumulate those. You're going to fund them to accelerate the growth up to $50,000 as quickly as you can, all right? Again, we're not looking to build this account to not be $1 million someday. We are absolutely striving for high sixes and 7-figure retirement someday. That's what we're striving for, and that's the retirement that you have to house those assets in, right? Because we're looking at a grander picture down the line, all right? Now, everybody's coming back at me and saying, well, Robinhood doesn't charge an entry and an exit fee. Again, it's the complete opposite of the philosophy that you should be following when you are a new investor, okay? When you enter into a stock in Robinhood, you are correct. You do not have to pay the $7 entry fee, okay? Another thing that you're missing is that you can't really sell that stock. If it goes up 20 or 30 or 40 or 50% in 6 months, you can't sell out of that position and not be hit with the capital gains tax, all right? So it's very, very short-sighted, right, to make your decision on what accounts you're going to open first based on entry and exit fees, all right? Because listen, here's what's going to happen. You're going to build that Robinhood account up to, let's say, 25,000 or 50,000 someday, and then you're going to say, oh no, what happened? I'm still saving on the entry and exit fees, but now I've got this huge lump sum of money over here that I can't trade in. I can't swing trade in this. I can't buy a stock and have it go up 10% in a day and trade out of it free of charge and take the money and accelerate my growth. Do you see what we're looking at here, guys, with the balance? There is a method to my madness, and a lot of it has to do with long-term thinking and not getting wrapped around the axle on short-term thinking, okay? And I'm not going to justify putting you guys into an account to save you $7 on the entry fee, all right? I'm not going to do it, all right? What type of investor do you want to be, okay? I've talked about it a little bit. You have to be an investor first. There's reasons for that. I have students that come up to me and say, you put me in the VOO. I watched it the first month go down $5. What do you want me to say? Okay, stocks go up and stocks go down. The positive that you take out of that is that, okay, what happened after that month? Oh, it went back up. Okay, see, that's the mental conditioning piece. That's the becoming an investor that you just can't jump into overnight. You can't. I went through the evolution of becoming an investor and a trader, and I expect that you'll go through the same evolution. Some people can deal with the swings. Some people can deal with the ups and the downs better than others in the market, and that's why assigning an appropriate risk tolerance before you get involved in the market is important, and also having an emergency cash fund aside, right, guys? But you cannot buy an AMD right out of the gate, okay, and just think that you're going to become a trader right out of the gate and expect that you're not going to emotionally react when AMD sinks down below 10, okay? You're not going to pick up an aggressive stock like GoPro and that's your first stock that you buy because you're going to lose your marbles when it goes down below 10. And then what are you going to do? You're going to be doing this right here. You're going to be twiddling thumbs because hold on a second. Now you're second guessing your decision to buy a second tier company, right, at the expense of really, really good investments. And now you're being reactive on the market and not proactive on the market. No pun intended, but you're sitting there waiting for a company like a GoPro or an AMD or a Sprint or some of these aggressive names, even NVIDIA, some of these high growth names, guys like Amazon and Netflix is another one to put in that camp. Guys, if those are the first stocks you're buying, guys, I wish you all the luck in the world. You might even make money, okay? It'll probably run up 20% and you'll think that you're going to quit your day job. That's sometimes the worst thing that can happen to a new investor is that they start trading right away and the worst thing that can happen is they make 10, 20, 30% profit right away. They don't realize the tax implication and they think that they've got the market licked. You are wrong on both cases. All right? We come and invest an investor first. That allows that couple years to get under our belt, maybe take a nice downturn because of geopolitical risk, or we watch the market take a downturn, right? And it gets us conditioned mentally to enter the market as a seasoned investor. Guys, it is a practiced art. It is a practiced art. It's not something that you're going to game. It's not something that you have to outsmart. It's really not. And becoming an investor is actually quite a bit simpler than what a lot of people give credit for. All right. The last thing is why. Why is it that we do this, guys? This is something that so many people go through life and they don't ever find really their niche. You know, they really don't find maybe their talent. You know, they work really, really hard and they spend all their time doing that. They live paycheck to paycheck, guys. They've never really taken a chance to step back and say, you know what, I might not understand 100% of this, but I'm going to take charge of this one thing in my life, this one thing. And for a lot of people, you know, being conveniently naive about the stock market and just going out and seeking the services of a financial planner out there who's going to charge you exuberant fees for that service is just not good enough for me. It's not. It's good enough for a lot of people out there because they want to live with their head in the sand for 30 or 40 years, only to retire someday and realize that their retirement accounts aren't where they should be. Guys, we think different on the Independent Investor channel. I'm looking to put you in direct control and directly associated with the market. You're not going to have any middleman if you pay attention to the lessons on the Independent Investor channel, guys. Thank you so much for tuning in to What is a Stock? I hope I've answered that with my particular twist. If you enjoy the information that's coming across about the stock market and you know anybody out there that could benefit from the information that I'm putting through, somebody maybe new to investing, certainly share the information with them. Turn them on to my free investing help, guys. I'm going to be putting that on until I get to 1,000 subscribers. We're probably a couple months at best away from that. I encourage you to take advantage of it, guys. There are folks that I've reached out to directly, and I can rest assured say that their lives are changed forever based on that 20 or 30-minute conversation that I've put out there free of charge, guys. Listen, if you have not subscribed to the channel, please hit the subscribe button. You'll be notified of any future videos that I put on YouTube. Thank you so much for tuning into the information, guys, and good luck in your investment future.